Hi everyone. Today the topic of our presentation is ISA 720, the auditor's responsibility relating to other information. So let's start with the introduction. Introduction to ISA 720. ISA 720 applies when an auditor is engaged to financial statements, an entity issue an annual report contain additional information. This standard does not require the auditor to audit that other information. However, it does require the auditor to read and consider it. The reason for this requirement is that users typically view the annual report as a single package of information. Any inconsistency between audited financial statement and other information can reduce the credibility of financial statements, even if the audit itself was properly conducted. Meaning of other information. Other information include both financial and non-financial information presented in audit annual report, excluding the audited financial statement and auditor's report. This information is usually prepared by management or those charged with governance. Example include the chairman's report, management discussion and analysis, operating reviews and future outlook sections. Although this information is not audited, it can strongly influence users' decision, which is why ISA 720 placed responsibility on the auditors to consider it carefully. Objectives of auditor under ISA 720. The primary objective of auditor under ISS 720 is to read and consider the other information to identify material inconsistency or material misstatement of fact. The auditor does not verify every detail but applies professional skepticism and judgment. If inconsistencies are found, the auditor must determine whether the information lies in the financial statement or the other information. The goal is to ensure that users are not misled by the conflicting or incorrect information within the annual report. Auditor's responsibilities. The auditor responsibilities under ISA 720 include reading the other information and comparing it with the audited financial statements and audit evidence obtained. The auditor must remain alert to information that contradict with was learned during the audit. This requires professional skepticism, especially when management present overly optimistic or selective information, while the auditor is not responsible for preparing or correcting other information. They are responsible for responding appropriately if issues are identified. Material inconsistency. A material inconsistency exists when other information conflict with audited financial statement. For example, if the financial statement show declining revenue but the annual report highlights strong growth without explanations. This may be material inconsistency. Such inconsistency can damage the credibility of financial reporting. When identified, the auditor must investigate further to determine whether the financial statement or other information need revision. Material misstatement of fact. A material misstatement of fact occur when other information contain incorrect or misleading misstatement, even if it does not directly relate to figure in the financial statement. For example, include incorrect description of event, inaccurate operational data, or misleading performance claim. When identified, the auditor discussed the matter with management and request correction. This ensures that users are not misinformed by factually incorrect information. Action when issues are identified. When the auditor identifies a material inconsistency or misstatement, the first step is to discuss the issue with management. Management is expected to correct the other information or, if necessary, amend the financial statement. If management refuses to take corrective action, the auditor may need to communicate with those charged with governance and consider the impact on the auditor's report. This action emphasizes the auditor's responsibility to protect users' interest. Reporting responsibilities. Under the revised ISA 720, auditors are required to include a separate section in auditor's report titled Other Information. This section explains the auditor's responsibilities and states whether any material misstatements were identified. If an issue exists that management has not corrected, the auditor must describe it in this section. This enhances transparency and provides user with clearer insight into auditor's work. Timing of reading other information. Other information may be obtained either before or after the auditor's report is issued. Regardless of timing, the auditor still has responsibility under ISA 720. If material misstatements are identified under the auditor's report date, the auditor must take appropriate actions. This ongoing responsibility ensures that misleading information does not remain unaddressed simply due to timing. Documentation requirements. Documentation is a critical aspect of ISA 720 compliance. The auditor must document procedure performed, discussions held with management, and conclusion reached regarding other information. Proper documentation support audit quality, demonstrate professional judgment, and provide evidence that the auditor fulfilled responsibility under ISA 720. Importance of ISA 720. ISA 720 is important because it strengthens the credibility of annual report as a whole. Users often rely on narrative sections as much as financial statement by ensuring consistency and accuracy across all information. ISA 720 improve transparency, build trust in financial reporting, and enhance the overall reliability of corporate disclosures. Scope of ISA 720. The scope of ISA 720 is limited to reading and considering other information including in the annual report. It does not extend the audit opinion to that information. The auditor's role is evaluative rather than investigative, focusing on identifying material inconsistency or misstatement rather than providing assurance. Purpose of ISA 720 is to protect users of financial statement from being misled by contradictory or inaccurate information by requiring auditors to consider other information. The standard promotes accountability, transparency, and confidence in published financial report. Practical example. Consider an example where an annual report states that the company achieved strong profit growth during the year. However, the audited financial statements show a decline in profit. This represents a material inconsistency. Under ISA 720, the auditor will discuss this with management and request revision of the other information to ensure consistency and accuracy. Quick summary of ISA 720. To summarize, ISA 720 deals with the auditor responsibility relating to other information. It requires auditors to read and consider such information, identify material inconsistencies or misstatement, and take appropriate action. The standard enhances the reliability and usefulness of annual reports. Conclusion. In conclusion, ISA 720 plays a vital role in modern auditing by ensuring alignment between audited financial statement and other information. It reinforces the auditor responsibility to safeguard users' interest and contribute to higher standard of transparency, accountability, and trust in financial reporting. Thank you.